Now, tonight, we turn the spotlight on the Finance Bill 2026 as debate, confusion and claims continue to flood social media and public conversations across the country. What is true? What has been misrepresented? And what could the proposed law mean for Kenyans, businesses and the economy? Now, to help us separate fact from fiction, I'm joined by CPA James Kimani, Associate Director at KPMG East Africa and a member of ISPAC's Public Finance and Taxation Committee. Bwana Kimani.
Yes.
Thank you so much for joining us.
Thank you for
Asante sana.
Thank you.
How are you doing?
Good, good. Yes.
First things first. What do you see are some of the big wins in the Finance Bill 2026?
Yeah, thank you, Peter. I think looking at this finance bill that has about 57 clauses, I only see two wins. One, there is the introduction of the amnesty. You'd remember that last year we had an amnesty that ended on June 2025.
Yes.
And what that meant is that a number of taxpayers then were able to get waiver of their penalties and interest for the prior periods. And that now has been reintroduced. So if you have penalties and interest up to December of 2025, and you pay the principal tax by December 2026, you essentially be exempted, or rather given a waiver of penalties and interest. And that's a good win, because it means there are people struggling with penalties and interest because of late payment of taxes, and not maybe because they wanted, but some scenarios could be company had an issue with cash flow and therefore they paid installment tax late, they paid PAYE late, and therefore that introduction or reintroduction of amnesty is a good win for taxpayer. That's one. The second, and perhaps the last win that I see, is on people selling bottled water. All the companies that were selling bottled water, they were paying excess duty at 6 shillings and 41 cents per every liter that they sell. And that have now been scrapped, essentially meaning that's a good win, and we can then see perhaps the bottled water, going a bit cheaper. Those are the two wins that I see. From the losses or those who might be, highly affected, I see a number of situations. One, people who are actually locally producing plastic items. And of course, Kenyans, in every house you go, you'll actually see a plastic item, yeah? And therefore, those companies that are producing plastics will highly be affected, because there is an introduction of excess duty of 10% on those products. And of course, you all are aware and appreciate that the cost of production in Kenya is quite high. And if then we introduce excess duty on those products, then it essentially means that the products that comes from other countries into Kenya are likely perhaps to be cheaper. And then we may have those companies start struggling. Okay. That's one of the bigger impacts that we have. And of course, remember, we struggling a lot, especially from the contribution of manufacturing sector into our GDP. It is now at a staggering about 7%. And we have moved this from about 10% contribution, it's going down to about 7%. And you remember, manufacturing really is a key sector that give a lot of employment to Kenyans. So that's a big loss, and I hope that the Committee for Finance and National Planning will listen to that. I think the other thing that I see is most of the products that come from East Africa and communities, they say from Uganda, Tanzania, in most of them they were actually not paying excess duty in Kenya. But there is now a concerted effort by the government to try and bring excess duty on all those products coming from East Africa. And that, of course, negates what we call the East Africa Treaty and what we call the Common Markets Protocols. So that's, of course, a big loss to the economy. And I think the major other issue that I would say would be a big loss, the government have really been saying that we need to go green. There have been a lot of support, especially on what we call ESG. But the government have now moved products, electric bicycles, electric buses, electric motorcycles, from zero rated to exempt. And just to explain briefly what that means is that the manufacturers of this product, or the assemblers of this product, initially they were able to claim inputs. And by inputs, I mean when you buy the product that they need or they import, they would incur an input VAT. At the point of selling that product, they were able to claim the input VAT, and therefore it could not increase the cost of that product. However, if you move that product to exempt, it essentially means that those electric bicycles, electric buses, there will be an added cost, because the VAT at the point of importing or any local raw material that they are buying to produce those electric buses and electric bicycles will have then to be increased at the point of selling, and therefore those products becomes more expensive. So there are several things in this bill that actually have a number of losses to the taxpayers and perhaps to the economy. And my hope is that the Committee for Finance and National Planning will look into this matter.
Okay.
Yeah.
With all those things that you mentioned, and I'd want to know, what does Finance Bill 2026 tell us about the government's economic thinking right now?
I think it's a catch-22 when you look at this bill, because one, we have got it to a point. Remember, the sources of government revenue would always be from taxes, would always be from perhaps borrowing, and what we call appropriation in aid, what you pay when you go to access, say, your passport and all those things. Those are the three sources of revenue that the government gets to be able to finance all the projects and to pay the civil servants. Now, the challenge we have is that we have, of course, gotten to a point of we cannot be able to borrow more. The other point is appropriation in aid. We don't get a lot from that. So we are only left with the element of tax. However, it's very difficult for the government now to be able to increase taxes. And what then they are trying to do is to what we call broaden the tax base. So they would, and you have heard the minister saying that they are not essentially increasing any tax, but trying to broaden the tax base. And that's why when you go to the issue of second schedule to the VAT Act, a number of those items like what I have mentioned, which are zero-rated, they are being exempted. To mean that these people will no longer be able to claim the input. So the money that the government will give back, they will not have to give, and therefore there is always what we call saving from a tax expenditure perspective. So they are trying to broaden the tax base against. So there is a balance in terms of economic stabilization and what we call domestic revenue mobilization. So it is always a catch-22 for any government, and therefore for me, what I'm seeing is that there is, of course, some efforts to try and make sure that there is no much increase in taxes. You would remember that the other finance acts that we have had in the last 5 years or so were trying to raise an upward of 200 billion. The current one that we have, Finance Bill 2026, intend to raise about 117 billion. So you can see perhaps the government is keen in terms of ensuring they don't increase the taxes so much. There's not so many new taxes that have been introduced. However, based on what I have said, some few items being increasing excise duty, moving them from one schedule to another, zero-rated to exempt or standard-rated to exempt, essentially means that the government is just trying to broaden the tax base. Yeah.
So can the government realistically broaden the tax base, as you call it, when incomes are not growing proportionately?
Yeah, Peter, you are right. It's difficult because remember, if you look at starting from the Income Tax Act, you pay corporate tax based on the income. So if there is no income, then it means there will be no taxes to be paid. Or if your income reduces, then it means you pay less. So therefore, it's difficult to be able to achieve that. However, what I see is that the government can have many proposals or many areas that can help them broaden the tax base, including what we are having as e-teams. Because if you look at Kenya, we have about 6 million people who are paying taxes, but we have potentially about 18 million people who actually have one form of income or the other. And therefore, it is possible that they can be able to increase the tax base through technology and through realignment, particularly on the tax expenditure.
All right.
Yeah.
Let's focus on Mitumba, and I'd want to know from you why you think the government has chosen to target Mitumba in the Finance Bill 2026.
Well, let me say this, Peter. One, in the finance bill that we are currently discussing, there is no introduction of tax on Mitumba from an income tax perspective. I know initially there was a document that was circulating in the media that had an amendment to Section 12, which was specific to Section 12H of the Income Tax Act, that then intended to introduce 5% tax on the CIF from the product imported from a Mitumba perspective. However, in the final document, it is important to clarify that there is no such tax. However, when you look at VAT, there is a section that is amending the taxes paid from a Mitumba perspective, and they are moving. When you import Mitumba, then you'll be paying VAT. I mean, you'll be exempted from VAT. However, at the point of selling, it means that you will not charge VAT, but you will pay VAT at the point of importation. So from my perspective, it's important I clarify that there is no income tax from a Mitumba perspective. There is a proposal in the VAT Act to move Mitumba to exempt, and that only at the point of selling, but not at the point of importing. Meaning, if you be importing, you still be paying VAT, but when you sell that particular clothes or shoes, then you not pay VAT. Of course, it is an advantage because that essentially means that the owners can be able to sell those products relatively cheaper. So I don't see a big issue in terms of the Metuba taxation. Yeah.
All right. What do you think? Why do you think there's a lot of misinformation in regards to the Finance Bill 2026? But before you even answer that question, I'd like us to listen to what the government spokesperson, Isaac Mwaura, had to say in regards to that.
We wish to clarify as a government the following: the public concerns and misconceptions regarding the Finance Bill 2026 to ensure all Kenyans understand the intended reforms and purposes of the bill. Regarding the excise duty, but it is commonly linked to sin taxes, such as those on alcohol and tobacco. Excise duty is in fact a flexible fiscal tool used for multiple purposes, generating predictable revenue, influencing consumption patterns, protecting the environment, and funding sector-specific infrastructure like road maintenance levies. The proposed excise duty on smartphones is not a new tax, but a consolidation of multiple existing taxes into a single, simpler framework. Smartphones are recognized as essential, high-utility devices in Kenya's growing digital economy, presenting a broad and stable tax base. This approach balances of revenue needs and digital inclusion. Kwa sababu ya wale ambao wanatengeneza madawa hapa Kenya, pia wameondolewa VAT kwa zile bidhaa ambazo wanatumia kutengeneza haya madawa. Hiyo itafanya nini? Itahakikisha kwamba madawa yetu ambayo tunayapata bei yake imerudi nini? Imerudi chini. Hiyo ndio vile Finance Bill inasema. Inasema vizuri kabisa ili tuweze kuwa na watu ambao wataweza kutengeneza madawa hapa, ndio bei ya madawa irudi chini. Sasa hii tunaagizia madawa mengi sana hapa nchini kutoka nchi za ughaibuni. Kwa mfano, utakuta kwamba katika bara lote la Afrika tunatengeneza tu madawa yetu 6% peke yake, only 6%, na ilhali magonjwa 25% yanapatikana hapa Afrika.
Your sentiment in regards to that? That was government spokesperson Isaac Mwaura.
Well, he has explained two issues:
yes.
The cost of mobile phones and the element of pharmaceutical products. Let me start with the element of mobile phones. And it is important to perhaps clarify as I start this that I think what we have seen the government thinking is that if we move a product from standard rated to exempt, we are still lowering the cost. Or if we are moving it from standard rated to exempt. It's not necessarily the case. If you look at phones, we have several companies that are manufacturing phones now in Kenya. Locally, and therefore they are able to sell that. And of course, we have other people who continue to import. So when you look at the ones that are actually imported, what you pay, there is a stay order or a stay requested by Kenya government so that we continue to levy custom duties on the imported mobile phones. If you go to the other East Africa countries, they do not levy any custom duty on imported phones. That's the first issue. The second issue is that on the imported phones, they charge VAT. So there's a custom of 25%, there's a VAT of 16%, then we have what we call the import declaration fee and railway development levy at 2% and 2.5% respectively. So, and then at the point of coming to sell those, at the point of, from an excess duty perspective, it was at 10%. Now, the locally produced phones, they were paying, they were not paying any excess duty. However, the VAT was related, and now the excess duty then, would essentially be now levied at 25%. So if you look at it from what the minister have mentioned, and what the spokesperson have mentioned, is essentially that they are consolidating all these taxes now to bring it at 25% on excess duty alone. And to the explanation is that the phones are likely to be cheaper. Not necessarily. One, the custom duty will remain, we still have the stay as we speak, and therefore, unless we submit the stay, of course, lasts for 1 year. If that then lapses, it means we stop charging custom duty, like other East Africa countries. Now, from an excess duty perspective, what has happened is that we have now increased 10% to 25%. But the VAT impact is different, because the VAT impact for imported phones was actually standard rated. However, for the local, it was zero rated. Meaning, what will happen is that we will have, these phones may not have necessarily the same cost. Actually, the person who is producing them in Kenya is likely to be disadvantaged. Because remember, we have moved all the phones to exempt. Remember, these people will buy materials in Kenya, they will import others. At the point of importing, you still pay VAT. So a local manufacturer will pay VAT. An importer will still pay VAT. Okay. However, at the point of selling, they have all been moved to exempt. It means a local manufacturer will not be able to claim the input VAT. Essentially to mean that actually the locally manufactured phone might be expensive than actually an imported phone. Okay. So of course the duty at the end will slightly reduce, that's for sure. But then we are disadvantaging the local producers, because it means the earphones are likely to be more expensive than the imported ones, and therefore somebody will go for the imported one.
Okay.
Yeah.
Now, as we wind up, many Kenyans are hearing that KRA could gain access to your M-Pesa transactions under the Finance Bill 2026. Is KRA fighting tax evasion or spying on Kenyans?
Let me put it this way. When you look at the amendment in the Tax Procedures Act, the amendment is that KRA may use information or data from third-party systems. It is not necessarily saying that they will be spying on your phones or your mobile transactions. It would mean, for example, if you are trading with somebody X and you have sold something and they have given you an invoice, and KRA is, for example, auditing that company.
Yes. Of
course, they get your invoice there and they see that you sold good worth 1 million. It essentially means they have gotten this information from a third party, but they can come to you and say, we saw there's a transaction you did of 1 million, please declare the income. That's one. But that's not also, it may also mean that, remember, if Safaricom were to give that data, or Airtel, or all these other telecommunication firms, it's also a third-party information, and therefore, if they get that information, they can come and actually assess an income from you. But what that amendment to the Tax Procedures Act says is that if they find a data from a third-party system that may be useful to have a conversation with the actual taxpayer, whether there is tax that ought to have been paid, then they can do that. So not necessarily that they will be spying on people mobile transactions. Yeah.
Okay. Thank you very much for that. One message for Kenyans worried about the Finance Bill 2026, very briefly, Mr. CPA James Kimani.
Yeah, I think for me, what I would say is that Kenyans need to be very keen on compliance from a tax perspective. Given the information we have seen in this bill, it means if you are not compliant, you are likely to pay more taxes, or even to pay taxes that is not necessarily due. So the element of somebody being compliant is critical. But more importantly is that we need to invest a lot from a technology perspective. When you look at the way the Revenue Authority have actually enhanced their technology, if you are not, again, around the same level, then you are likely to be disadvantaged. That's the two elements that perhaps I would want Kenyans to note.
All right.
Yeah.
Thank you so much for your time, and thank you very much for your insights and helping us unpack some of the concerns surrounding the Finance Bill 2026. Thank you so much. That was Mr. CPA James